it can be a little confusing figuring out how the residual value affects the lease liability for a lessee under IFRS 16. So I just want to go through this to make it crystal clear. So first of all, the residual value is only going to affect the calculation of that lease liability if two things are true. Number one, the lease contains a guaranteed residual value. That means that the lessee has guaranteed the lessor that that leased asset will have a certain value. Okay, that's the guaranteed residual value at the end of the lease term. So, for example, if they said, look, it's going to be worth 8,000 euros at the end of the lease term, then that would be the guaranteed residual value. Now, not only do we need a guaranteed residual value, we also need the expected residual value. So that's what the lessee thinks that the residual value is actually going to be, like what the fair value of this asset is going to be at the end of the lease term. That needs to be lower than the guaranteed residual value. If both those things are true, then the residual value will affect the lease liability. And let me give you a hypothetical here. So let me give you an example. So let's say that there's a guaranteed residual value and it's $10,000. And the lessee, the expected residual value, they say, you know what, I think it's actually going to be $3,000. So they guarantee the lessor, hey, this thing will be worth 10 grand when this lease term's up. But they're thinking, well, I think it's only going to be worth 3,000. Okay, that difference of $7,000, that would be treated as an additional lease payment when calculating the lease liability. Remember, the lease liability is basically, it's the present value of all the expected lease payments. So this shortfall, there'd be a $7,000 shortfall, and basically the lessee is saying, hey, look, when the lease term is up, I'm going to have to give that lessor 7 grand to make up for the fact that I guaranteed 10, but it only came in at 3. Okay, so I've got a little summary here. Hopefully this is helpful to you. The only scenario, we've got three different situations here. We've got where we don't have any guaranteed residual value at all. We just have an unguaranteed residual value. If that's the case, then the residual value is going to have no effect on the computation of lease liability. If the expected residual value is higher than the guaranteed residual value, so in this case is lower, but what if it was higher? What if it was, instead of 3,000, it was 14,000? Then this is not going to affect the lease liability because the lessee is thinking, look, I guaranteed 10. I think it's going to be worth 14, so I'm not going to owe the lessor any money. So that's why there's no effect there, okay? It's only when there's a guaranteed residual value and the expected residual value is lower than what the lessee guaranteed the lessor, okay? And that's when you got to take the present value of the difference. Okay, in this case, before where I had $10,000 and $3,000, it was $7,000. The present value of that would be factored in the lease liability. Now, there's an additional complication here. What if this is going to get a little complicated? Hang with me. What if the expected residual value, okay, what the lessee thinks the residual value would be, is less than the guaranteed residual value, and that shortfall, which up here was 7,000, what if that turns out to be even greater than, so we said 7,000? What if it turns out to be 9 or whatever thousand, right? What if it's even higher? Okay, so let's go back. I know I wrote a lot of numbers here, so let's go back. So we had 10,000, and I said that they were expecting it would be 3,000, okay? But what if at the end of the lease, we get to the end of, so this is just what they expected. What if we get to the end of the lease and it's really, the asset's only worth 1,000? Then it's like, well, if the shortfall is not 7 like we expected, there's actually an additional 2,000. Okay, there's an additional 2,000 there. So the shortfall is basically higher. In that case, the lessee at the end of the lease, when they find out, oh man, this is shortfall is even higher, they would record a loss. Okay, they would book a loss. Okay, so that would affect their profit. Now let's do an example because it's a little more difficult than you might be thinking. So company A, they're the lessee. They rented some equipment. There's a guaranteed residual value of $15,000. Now they expect the residual value to be 10,000. So guaranteed of 15, expected of 10. So that's going to affect the computation of lease liability. They're expecting a shortfall of $5,000. They would take that into consideration when calculating the lease liability. But at the end of the lease term, okay, at the end of the lease term, the actual residual value, I hope I'm being clear about this. This is what they find out. The lease is over, and they're like, all right, what's this thing worth? The actual residual value ends up being just $8,000. Now, we've got a scenario where we're guaranteed 15. We thought it would be 10, so we took into consideration that $5,000 shortfall when computing the lease liability, but it came in at 8, not at 10. So that extra 2,000, we book a loss on the lease. Okay, so we record a loss, and then we're gonna also have to decrease our cash account. Now, you might be thinking, hey, wait a minute. Why is this not a $7,000 loss? Because we guaranteed 15 and it comes in at 8. Okay, it's only worth 8 at the end of the lease term. So why is it not a $7,000 loss? Why are we recording a $2,000 loss? And here's why. We took into consideration already. So there's a $7,000 difference here, right? This is 7. We already took into consideration the $5,000 of that difference. The expected, we thought it would be 10. Like, we knew it would be less than 15. We thought it would be 10. So that 5,000, we already factored in the present value of that into the lease liability. Okay, so we already saw that. We factored that in the lease liability. That's why that's not part of the loss, that $5,000 shortfall. The 8,000 in the 10, we thought it would be 10, but it was 8. That 2,000, we didn't factor that into the computation of lease liability when we did that at the commencement of the lease. Okay, so we didn't account for that. This was a surprise. And so this comes at the end of the lease, and we say, oh, okay, 2,000. All right, we're going to have to give them an extra $2,000. We didn't factor this in earlier, so we book a loss, and then we pay out cash to the lessor.